Hello all, welcome to Get Into IAS, and in this video we are going to deal with the next lesson, Indian Financial System Capital Market. So we've done with money market, now moving to capital market. So what is a capital market first of all? Capital market is a market that lends long-term funds to the governments as well as the industries. So normally the governments borrow long-term funds in the capital market. So we'll deal what is capital market, fine. So the institutions in capital market are called as NBFCs, non-banking financial companies. See, other than banks who all are doing lending, borrowing activity, share, equity, all this is called as what? Non-banking financial companies. So other than banks, the other institutions which does the same work, same kind of work as banks are called as non-banking financial companies. Not exactly the same, but somewhat equivalent to banks. Fine. So the institutions in the capital market are called as what? NBFCs. So the various kinds of NBFCs are HFCs, that is the housing finance companies, stock exchanges, the venture capital funds, the Nidhi companies, and so on and so forth. Fine. And the chit fund companies. And there are many examples for the non-banking financial companies. We'll deal with that later. So now, not all NBFCs are in the capital market. Very important thing to be noted down. See, I told you all the institutions in the capital market are called as NBFCs, but not all the NBFCs come under the capital market. Some NBFCs are outside this capital market. Okay. See, RBI defines this NBFC, non-banking financial companies, as what? As a company that is registered under the Companies Act of 1956. So if you are going to start an NBFC, you should register yourself in the Companies Act of 1956, and they tend to give loans, advances, participate in the stocks, and they also provide bonds. Fine. And does not include agricultural, industrial activities, sale and purchase of immovable property. Very important thing. See, I told you all what are the works of NBFC over here. And the works, the activity does not include the agricultural, industrial, sale and purchase of immovable property. All these things, all the activities concerned with these things does not constitute an NBFC. Fine. So we have the various other institutions for that, like NABARD and all. Now coming to an NBFC. So under NBFC you have the deposit taking NBFC and the non-deposit taking NBFC. Fine. Deposit is, for example, if I am person 1, I go deposit in a bank. Fine. So I am a depositor. Fine. So same way there will be an NBFC. So I'll go deposit in an NBFC. So this is deposit taking NBFC, and there are certain NBFCs which does not take any deposits. Now those are called as non-deposit taking NBFCs. So these are the features, some of the features of NBFC, very important for prelims. Fine. So the NBFCs accept deposits but not demand deposits. See, I told you all NBFC accept deposits, right? In this itself there is an exception. What is it? That is, it does not accept demand deposit. So there are two types of deposit, demand deposit and fixed deposit. See, for example, under fixed deposit, there is a 1 year term. Fine. After 1 year only, the NBFC will give me back the amount. Fine. My amount what I deposited. But this is called as fixed deposit. Under demand deposit, we have the various accounts called as savings account, current account, all these in banks, right? So whenever I demand the banks to give my money back, they should give it back, right? There is no such institutions in NBFCs called as the demand deposit taking NBFCs. Fine. I hope you are clear with this point. Next, NBFCs are not part of the payment and settlement system. Very important. All the banks are a part of the payment and settlement system. Banks will issue checks, but NBFCs can't issue checks. That is the difference between bank and NBFC. Next, bank deposits have insurance coverage. See, if I go deposit in a bank, for example, take IOB bank, fine. I am depositing 5 lakh rupees in bank. My deposit is how much? 5 lakh rupees. So in case if the bank fails, who will give me this 5 lakh rupees? So this 5 lakh rupees will be insured, My 5 lakh is insured by the Deposit Insurance and Credit Guarantee Corporation, DICGC. Okay. So this institution will give me back my 5 lakh rupees. Earlier the limit was 1 lakh only. Fine. Only 1 lakh is the amount that the bank could be able to give me. See, in case if I deposited 2 lakhs, earlier I'll get only 1 lakh if the bank fails. But now they have changed it to 5 lakh. So in case if I have deposited 6 lakh over here, the bank will give me only 5 lakhs because, so that is how the Deposit Insurance and Credit Guarantee Corporation assures me my amount. Fine. So this is the threshold limit. The threshold limit now is 5 lakh. So you guys tell me which committee recommended the increase of amount from 1 lakh rupees to 5 lakh rupees. So you have to let me know the committee in the comment box. Fine. Okay. So now moving to the NBFC is not insured by any institution like this corporation. Deposit Insurance and Credit Guarantee Corporation insures for the bank failures. But there is no such institution for NBFC. This is very important in prelims point of view. Next, coming to the composition of the capital market. So we are dealing with capital market. Let's deal with the composition. See, first thing is the securities market. So under the capital market, you have something called as a securities market. We already dealt with the government securities. It is the same way. See, securities markets deal with the shares. What are shares? We have equity shares, we have preferential shares, we have derivatives. We'll deal with each of the term later. Fine. Just now keep it in mind, the security market consists of shares. And the security market consists of even the debt instruments. What are called the debt instruments? For example, bonds, debentures are called as debt instruments. See, normally a share is, see, if there is a company, there is investor 1, investor 2, investor 3. So, investors means they put their share amount, certain amount of money. See, if there is 100 rupees, he will invest 25, 25, 25 and 25. So, each is contributing rupees 25 and hence the share of each person is 25 rupees. Fine. So, that is called a share. So, under the share, there will be capital and profit. So, the capital he has invested is 25 rupees. So, on the whole, the capital comes to be 100 rupees. And if there is a profit of rupees 200 rupees in this business, this profit will be shared among these 4 people. So, this is called as share. What is called as debt instrument? So, under the debt instrument, we have the same investors, but there is no share in the capital and profit. In the debt instrument, there will be like, see, so in case if I am lending rupees 100 to someone, that person will return back to me 110 rupees with the interest. So, there is no such thing called as capital and profit, sharing of capital and profit. Fine. So, these are called as debt instruments. Now, let's move to debenture. So, I told you all here, right? So, under the debt instruments, we have what? Bonds and debentures. You are already clear with the bonds. We dealt with various kind of dated government securities called as bonds. And now moving to the, we saw about zero coupon bonds, T-bills, all that. Right. Now moving to debentures. What are debentures? Debentures are like a bond. I told you what is a bond. So debenture are like a bond. Then what is the variation between debenture and a bond? See, but they are unsecured. Bond is secured. Bond is like it will have certain maturity period. Say for example, 1 year will be the maturity period and interest rate will be 2%. All this will be enlisted in a bond. But inside a debenture, it won't be enlisted. It will be unsecured. They won't let you know the number of the maturity period and the interest rate. It will be unsecured. You have to give your money and you have to wait for the money to come back. Those are called as debentures. Fine. The risk is very high, but the return is also high. Fine. That's why you are going and investing in what? A debenture. See, the lender will lend to the companies through these debentures. Fine. Okay. Next, coming to the shares. So, we've done with the debt instrument. Now, coming to the shares. I told you there are 2 kinds of shares, equity shares and preferential shares. So, what are called as equity shares? See, claim over the capital plus profit or the loss are called as equity share. In case if someone is investing, same like the investors, share 1 and share 2, 50:50 they are investing. Fine. So, this is the capital. Rupees 100 is the capital. In this, it may occur profit or this business may go into loss. So, all these is backed by the equity holders. So, these are called as equity shares. Next, coming to the preference shares. So, under this, a fixed rate of interest is fixed. For example, there is a bond. In that bond, they will tell you 10% of interest rate. So, this 10% is fixed there. Same way, under equity also, if there is a company, if I am going and investing in that company, the company will take the money from me. I am going inside as an equity. That is, I am going inside as a shareholder. Fine. I am investing in the company. So, I am a shareholder in the company. But what the company will tell me, for the amount you have invested, I will pay you interest at a future date. So, that is called as preferential shares. So, I preferred only and I went. But equity is not like that. I can claim a claim over the whole amount of money, the profit and the loss. But under this preferential shares, the company owner will tell me, I will give you only so and so interest rate on whatever profit I get. Fine. Now, coming to the securities market. We are dealing with the securities market only. There are 2 kinds of securities market. government security market and the industrial security market. We already saw government and industries need a lot of money to run the economy. That's why they constitute the capital market. They lend long-term loans from the capital market. Who? The government and the industries. So under the government security market, it is otherwise called as what? The government is lending the long-term funds from the capital market. They are called as gilt-edged market. Very important term. What is a gilt-edged market? Gilt-edged market is the government security market. Why it is called as gilt-edged market is, it is of best quality. See, if I go invest my amount of money in a government security, my money is secured over there. I will get my money back at a future date. Fine. And they are more reliable. People will rely on them. Instead of relying on a private security, I will be relying on the government security because I know at a future date I will get my money back. Next, coming to the industrial security market. So that is issued by the industries or the commercial organization, same way. See, under the government security and the industrial security, it is being traded in the primary market and the secondary market. Fine. I'll let you all know about the primary market and secondary market. But as of now, remember, the government security and the industrial security market is being traded in primary market as well as the secondary market. Fine. So now moving on to the next topic, the new and the old market. What is called as the new market? What is called as the old market? So under the new market, first time the bonds or shares will be issued in the market. Okay, that is called as the new market or the primary market. What is called as the secondary market? So already issued in the primary market is sold or purchased in the secondary market. See, in case if there is a company, this company is first time issuing shares. That means first time it is in need of money and it is issuing what? Shares. So these shares are got by the public. Fine. So if it is first time issuing these shares, it comes under the primary market. Okay, or the new market. So if it is old market, if it is issuing the shares for the second time, it is called as a secondary market or a old market. Fine. So this is called as what? This is called as new and old market, and this new and old market is regulated by SEBI, Securities and Exchange Board of India. So let's deal with SEBI. Okay, SEBI was established in 1988. Very important, 1988. And it was made into a statutory body. That is, it was brought under a law in 1992. Fine. So the head office of SEBI is in Mumbai. Very important. Where is the head office of SEBI? It is in Mumbai. It has three other regional offices in Delhi, Kolkata and Chennai. So please note this down. The head office of SEBI is in Mumbai. So next, coming to the public and other issues. So we're going to deal with public and other issues. Okay. So see, issue of securities to public. So normally there is a bond or share or equity, anything. Fine, those are called as securities. That securities is issued to the public. That is called as public and other issues. Let's deal with public issues first and let's deal with the other issues next. Okay. So coming to the public issues. So under this, if a company issues share for the first time. So I told you all there is a company. It is in need of money. So it is issuing shares. So these shares are got by various public, that is the individuals. Fine. So that is called as initial public offering. They are coming to the public and offering the shares for the first time. Initially, first time. Okay. That is why it is called as initial public offering. For example, a new startup company. For example, you can take Byju's. It is a new startup company, right? So when they are coming into the field, they are issuing shares for the first time. And they are clubbing out money from the public. So that is called as what? A new startup. A new startup issuing the shares for the first time in the market and getting money from the market is called as what? Initial public offering. Now coming to flow on public offering. Initial public offering is IPO. Flow on public offering is FPO. What is flow on public offering? It is the opposite of initial public offering. Again, issuing shares to raise fund. For example, take the same Byju's. It is a startup. It issued shares for the first time. Again, it is in need of additional fund and hence again it is issuing more amount of shares in the market. So more amount of money is pooled in, right? So this is called as what? Flow on public offering. Fine. Next, coming to the issue processes. So under issue processes, you have price issue and book building issue. So what is price issue? So under price issue, the issuer offers share at prefixed prices. See, I am offering a share. Take 100 rupees per share. per share is I have to go invest 100 rupees, but the whole total share will be 1000 rupees, but for per head the investment rate will be 100 rupees only. So this is fixed by the issuer, that is the company. Company is the issuer of shares, right? So what he will do is he will fix the rate, he will fix the price before selling itself. So that is called as price issue. Price issue is he is fixing the price before itself. So issuer offers share at pre-fixed prices. One share is how much rupees? 100 rupees. What is book building issue? So book building issue is price is not announced. So under the book building issue, price won't be announced at the earlier date. Instead, what the company will do, the issuer issues the shares based upon the demand. So depending upon the demand, he will fix the price. For example, if the demand is high, the price will be high. If the demand is low, the price will be low. Fine. See, for example, if you go to market, friend 1, friend 2, there are two people here. So these two people are fighting for a product, say a book. Fine. So what the shop owner is thinking, there is a demand for this book. So let us increase the price for the book. So initially the price of the book was 100 rupees. After seeing them fighting, after seeing the demanding for the book, he is increasing the book price to 200 rupees. So that is why it is called as book building issue. Okay. So after the demand, they will issue the shares, that is the price of the shares. Next, initial public offering and the flow on public offering. Issuer does not issue directly. See, I told you there is Byju's. They are issuing shares, right? Byju's won't come directly and issue shares. What he'll do, instead there will be an intermediary in the between. There will be a company. This company, between this company and the public, there will be an intermediary. This intermediary is called as whom? Merchant banker. He is dealing with money transactions, right? So he is called as merchant banker. So the company will appoint a merchant banker. He will take care of all the money. He will pool in all the money and give it back to the company. Fine. So for fundraising, what is the main job of the merchant banker? His work is fundraising. Next, coming to the authorized capital and the issued capital. What is called as the authorized capital? Authorized capital is nothing but it is decided by the company. Maximum collection of capital. See, for example, I am issuing a share. There is a company, that company is issuing shares. So this share, the maximum amount, the maximum threshold limit is 100 rupees. Fine. So maximum limit is the authorized capital. Fine. Then what is called as the issued capital? Actual amount issued by the issuer. So the issuer may think, in case if I am getting 100 rupees from the market, tomorrow I should repay back the amount, right? I should repay back the amount along with certain amount of profit. So what I will do, I will reduce this amount. I will reduce the maximum amount to 50 rupees. So this is the issued capital. What the issuer is thinking in his mind, he will issue only those amount of shares to the people, and hence that is fixed by the issuer. That is called as issued capital. Okay. So know the difference between these two. Authorized capital is the maximum amount of capital a company can hold in, but the issued capital is what the issuer thinks, what the company thinks, only so much shares he will let out. Fine. So these are the two kinds of capital. Now coming to the subscribed capital, oversubscribed capital, undersubscribed capital. Fine. See, under the subscribed capital, so after the company issues shares, the public subscribe. So company, in the first case, it is issuing shares. Public will come and they will get the shares by giving the money amount. Okay. The subscription sometimes may be more than the issued capital. See, issued capital I told only 50 rupees he is trying to issue. But what? So more amount of public is coming forward and trying to get more amount of shares. So see, from 50 the share is going up to 70 rupees. Keep it like that. So if it is so, it means it is oversubscribed. So if the subscription goes more than the issued capital, that is called as oversubscribed. Fine. What is undersubscribed? The opposite of this is undersubscribed. See, 50 rupees is the issued capital. If the public comes and gets the shares for only 40 rupees, it is called as undersubscribed. The actual amount of subscription is called as subscribed capital. So see, maybe the actual amount of subscription may be 45 rupees. So exact amount is called as subscribed capital. Okay. So what is called as an underwriter? Underwriter is the financial intermediary who agrees to purchase the unsubscribed proportion of the issued capital. I told you, take the same example. The issued capital, what the company thinks is he needs 50 rupees. So he is issuing shares for the 50 rupees. But how much is actually subscribed by the people? Only 45 rupees is subscribed. And hence 5 more rupees is lacking for the company. And hence that gap, that void is being filled by the intermediary. So there will be a person called as intermediary. He is the underwriter. What he will do is, he will tell the company, okay, I will purchase the other 5 more rupees. So he is called as the underwriter. I'll reread. See, the financial intermediary who agrees to purchase the unsubscribed portion of the issued capital. I hope you're clear with this point. Coming to the next point, see, the company collects capital through installments only. See, if I am subscribing to rupees 5, okay, I don't need to pay the 5 rupees at once. So how the company is telling me to pay? He is telling me to pay through installments. I may pay 2 rupees, I may pay 2 rupees and another 1 more rupee. I may pay through installments. This 5 rupees I may cut it and pay to the company. So the company will collect through installments only. That is called as the capital. So my capital, how much ever I paid, that is my capital. So my capital initially is 2 and next one totally 5. See, what is paid up capital? So under paid up capital, it is paid by the subscribers. This is called as called up capital. So what the company is telling me is, you pay through installments. So he is giving me the instructions. That's why it is called as called up capital. If in case I am deciding to pay instead of 2 rupees, I am deciding to pay 3 rupees and next 2 rupees. So this is my decision. So this is my paid up capital, paid by the subscriber. I am paying to the company. Okay. Next, what is called as the reserve capital? So called up capital. Next one is the paid up capital. Next one is the reserve capital. So under reserve capital, small amount of money is undemanded. So always what will happen is, so under this 50 rupees is the share. See, under this 50 rupees, take 47 rupees will be subscribed by the people. 3 more rupees won't be subscribed. So this is the reserved capital. Small amount of money is undemanded. So this is undemanded. Fine. So we've dealt with the kinds of capital. So these are the authorized capital, issue capital, subscribed, undersubscribed, oversubscribed, underwriter, and then next one is the called up capital, paid up capital, and the reserve capital. Fine. So now moving to the private placement. So under the private placement, you have the qualified institutional buyers. So who are called as these qualified institutional buyers? For example, see, the private placements are made to qualified institutional buyers. So these QIBs are those who are deemed financially sophisticated and are recognized by the security market regulator to need less protection from the issuers than most of the public investors. See, for example, if there is a rich person here, there is a poor person here, okay? Both are investing. Fine. Both are investing. He has a lot of money, but he has very less amount of money. So who has to get more amount of protection? The poor person has to get more amount of protection. But there is no need of protection for this rich person. So he comes under the qualified institutional buyers. Fine. And now these institutions like the mutual funds, the financial institutions like the scheduled commercial banks, insurance companies, provident funds, pension funds, state industrial development corporation, etc. fall under the definition of QIB. Very important. Please note this down. They may ask in prelims, who are the qualified institutional buyers? Okay. So again, I'll repeat. See, these qualified institutional buyers are those who are deemed financially sophisticated. That is, there is a sound finance behind them. Fine. And are recognized by the security market. Recognized by whom? The security market regulator to need less protection. So only less protection is needed. Fine. From the issuers than most of the public investors. Fine. Next, moving to the rights issues. So under the rights issues, it is a security to follow on public offering. So we saw about the initial public offering. After that, again, if the shares are issued for additional capital, that is called as the follow on public offering. Right. So that is called as rights issues. Next, coming to the bonus issue. Bonus issue is the offer of share plus profits. See, normally a company is offering share. So for this share, later the company is turning a profit. So they're taking all the amount from this share, doing business, and for that business they'll get what? Profit. Again, what is happening? This profit is again turned into share of that person. So already the person has invested some amount as share, plus this profit is also taken into the share amount. So the share keeps increasing more and more. That is called as the bonus issue. Fine. So again converted into shares. The profits are again converted into shares. Coming to sweat equity issue. What is called as sweat equity? Sweat means you're doing hard labor. Correct. Employees of a company, right? For them, the shares are given voluntarily. Okay, because of hard work, hard labor. And the intellectual property rights, the technical know-how, all this is given by the employee to the company. See, normally if there is a company and the laborers inside the company are working very hard. So what the company is trying to do, it is trying to issue shares to them. Fine. It is telling them, you invest in these shares and later the profit will be shared to you. Fine. So these are called as sweat equity. So the shares are being issued to the employees by the employer. Fine. So normally the shares won't be issued like that. We should go and get the shares from the company. Company itself will issue share to the employees. Next, coming to the, so this sweat equity issue is issued at a discounted price. What is a discounted price? See, normally the share of the company is 100 rupees. Okay, per person. But what the company owner will tell, you don't need to invest a share of 100 rupees. Instead, invest only 50 rupees. Fine. I will give worth of profit, the share worth of profit of rupees 100 rupees to you. Fine. I think you got the point. So that is called a sweat equity issue. So by this, the laborers who are working inside the company will work more for the intellectual property rights and the technical know-how. Fine. Next, under this, the Companies Act of 1956 observes the sweat equity as follows. See, sweat equity shares means equity shares issued by the company to the employees. So, who all are working, the company itself is issuing. Fine, this is given by the Companies Act of 1956. Or directors at a discount or for consideration other than cash for providing know-how. So, instead of paying you in cash, what I'll do, I'll turn that cash into shares. Fine. For providing know-how or making available rights in the nature of intellectual property rights or value additions by whatever name called. Fine. So instead of he's telling this company owner, instead of paying you in cash, I'll turn this cash into shares at a discounted rate. Fine. Okay. So there are two other ways of incentivizing the employees and directors of the company. So not only by sweat equity issue, you can incentivize the employee, but there are two other ways. What are the two other ways? First one is the Employee Stock Option Scheme, ESOS, and the next one is the Employee Stock Purchase Scheme, ESPS. There are two schemes, please note that down. And then under the ESOS, that is the Employee Stock Option Scheme, the whole time directors, officers or employees. So inside that company, there will be directors, officers or the employees of the company are given an option to purchase the shares of the company at a future date at a predetermined price. See, the shares of the company will rise, will come down, okay? You may not know at the future date if it is in the rise top position or if it is in the medium or bottom position. What the company is telling is at a future rate, whatever the rate may be, don't worry about that. See, tomorrow the share of the company, tomorrow the share may increase to 150 rupees. Today it is only 100 rupees. But the company is telling it's okay, you purchase it for 100 rupees, predetermined price. Don't worry about the future date. That is called as Employees Stock Option Scheme. Then what is called as Employees Stock Purchase Scheme? So under this only the employees are offered shares as part of public issue or in some other way. So earlier we saw the directors and the employees were given that option. Now only the employees are given that option, that is under ESPS. Usually the share cost is deducted from the salary between the offer date and the purchase date. See, there is an offer date, there is a purchase date. There are two dates, okay. The company will be offering the employees on that day to buy the shares. That is called as offer date. But the purchaser, that is the employee, will be purchasing at a specified date, some other day. So the difference between these two, right? Usually the share cost is deducted from the salary between the offer date and the purchase date. So there are two kinds of dates, right? So that is the offer date and the purchase date. Offer date is the date at which the employer is telling the employee to buy the share. That is called as offer date. But the purchase date is the employee may be going and getting the share at a certain date. See, this may be 29 and this may be 30. So between this only the share amount is fixed. So that is deducted from the salary. That is called as what? ESPS. Fine. Okay. Next, moving to the old issue market. So under the old issue market, we've already dealt with that. See, new issue market is the primary market When in this primary market, again if the securities are or the shares are sold or purchased, that is called as old issue market. Fine. So under this, take an example, stock exchange. Stock exchange is an old issue market. Next, over the counter exchange, that is also old issue market. So you should differentiate between the old and new. Fine. Stock exchange is what? Old issue market and not new issue market. Fine. Next, coming to the trading process, we are going to deal with this only. First is the stock exchange. So under the stock exchange, the company won't go directly trade all the shares to the people. I already told you. There will be brokers between them, in between the people and the company, there will be trading brokers. So what these brokers will do? So stock broking companies. So these brokers will have what? Stock brokering companies. What will happen is the buyer or the seller of the shares. If I am the buyer of the share, I will go approach the broker. In case if I am seller of the share also, I will go approach the broker or the stock broking companies. So how the trading is happening? See, brokers are registered members with stock exchanges. Stock exchanges, old issue market. If I am a broker, I will go register in that. Okay. So next, sub-brokers are trading persons affiliated with brokers. So under me, there will be many sub-brokers. They act like branches to brokers. They are subjected to SEBI guidelines. Security and Exchange Board guidelines are subjected to both these brokers and these sub-brokers. So the types of trading are different based on time. So this trading process, right, it differs based on what? Time. Okay. So first one is the cash trading. See over here, cash trading. Next one is the forward trading. What is called as cash trading? So cash trading, in cash trading, the sale and purchase of securities takes place in a prevailing price on the day of trading. So what they're telling, in cash trading, the sale and purchase of securities take place in the prevailing price on the day of trading. So under cash trading, see, if today the share of the price is 100 rupees, me and the seller and the buyer, what they'll do, they'll have a nexus between each other and they'll fix the share to be 50 rupees. So on this day itself, what I'll do, I will purchase the share for only 50 rupees and not 100 rupees. So that is called as what? Cash trading. Cash is predetermined. Okay. So I'll repeat, see, cash trading, the sale and purchase of securities takes place in a prevailing price on the day of trading. Fine. See, there are two types of trading, right? Cash trading and next one is the forward trading. So both depends on the time. So this cash trading or the forward trading depends upon the time. So under cash trading, see, what is happening is the sale and purchase of securities take place in the prevailing price on the day of trading. For example, if the prevailing price of the share, the company, if I am a company, I am issuing what? Shares. So if the prevailing price of the share is 100 rupees, so today I have to give 100 rupees and get this share. So this is called as what? Cash trading. Cash trading is taken place on that day itself. The price at that day is fixed for that day. That is called as what? Cash trading. Then what is called as forward trading? See, under forward trading, both buyer and seller agree to buy and sell respectively at a future date at a pre-agreed price, irrespective of the price that prevails on the day of trade. For example, see, same way, there is a company. This company issues shares. So on this day, the share is 100 rupees. I may not know on this day what the price of the share will be. See, I am on date 17. But on date 19, I may not know what the price of the share, will it rise or will it come down. So what I am doing, I am fixing at a predetermined price. I am fixing the share to be 50 rupees and whatever the price may be at the date of 19th, I will not care about that. That is called as what? Forward trading. So I'll repeat, see, in forward trading, both buyer and seller agree to buy and sell respectively at a future date at a pre-agreed price, irrespective of the price that prevails on the day of trade. Okay, so there are two types of forward trade. So again, under this itself, there are two types, that is futures and options. So these two are called as derivatives. Very important for prelims. What are called as futures and options? They are called as derivatives. Fine. So I'll let you all know about futures and options. See, one is future and other one is option. Though both are forward trade, the method is slightly different. So in case of futures, both buyer and seller have to execute the agreement. See, future means something that is prefixed. Fine. So future, if the buyer and the seller of the share has decided something, they have to execute. No matter what, they have to do that thing. So that is called as what? Futures. Option is the opposite of that. Okay. Option is, see, in case of option, the buyer and seller can withdraw from the agreement. So in case we both have written an agreement on a share, any one can leave out of the agreement. So that is called as what? Option. He has the option to leave out. But there is a condition over there. What is that condition? See, to have this option, the buyer or seller has to deposit some amount of money as premium. Very important. See, under options, buyer or seller can withdraw from the agreement and leave any time. Right. So, see, in case if the buyer is willing to leave and the seller is not willing to leave, then there should be something, right? For this only, there is something called as the premium. So, before signing this agreement, he has to deposit rupees 50, he has to deposit rupees 50. So, in case if the buyer is willing to let out of the agreement, both this rupees, 50 rupees will go to the seller. So, this is called as what? The premium. So, I will repeat, see, to have this option, the buyer or seller has to deposit some amount as premium. In case he fails to execute the agreement, he has to forego the premium amount. So, he has to forego. For him, this 50 rupees is a loss. So, he has to forego. Next, the choice available to seller not to execute the agreement is called put option. There are two things called as put option, call option. So, if the seller is willing to move out of the agreement, it is called as put option. The choice available to seller not to execute the agreement is called as the put option. If it is available to the buyer, it is called as call option. So, there are two options, put option and call option. Choice available to the seller not to execute the agreement. He is not willing to execute the agreement. That is called as put option. The buyer is not willing to execute the agreement. That is called as call option. Fine. So, I told you what is the futures and options. I told you both is called as the derivative. Now, we will deal about derivatives. See, the futures and options are derivatives. Derivatives means any agreement like futures and options which doesn't have independent value. It doesn't have independent value. For example, see, if there is a cow, okay, there is a buyer, there is a seller. Okay, this buyer is telling the seller at a future date, say after 2 years, I will buy this cow from you. Fine. So, he is telling, I will buy this cow at 50 rupees from you. Okay. The market rate may be whatever after 2 years, but I will buy the cow at 50 rupees. So, this 50 rupees is the derivative here. This is the underlying asset here. Fine. And this underlying asset doesn't have an independent value. It has a fixed value. That is this rupees 50, what they both have agreed. Fine. So, this is what the underlying asset. Okay, the underlying asset is the cow, and for that they are putting a derivative. Fine, that derivative is called as what? Maybe future or option. See, the agreement to trade in future doesn't have any value, because in future the value may rise or the value may come down. But the buyer and seller doesn't care about that, because already they have signed an agreement. Fine. So, it has value only because of underlying securities which are to be traded. So, the underlying security here is the cow. So, on the whole, they are prefixing, they are predetermining the rate before the market rate could arrive. So, that is called as what? Derivative. They are deriving at a price before the market price. That is called as what? Derivatives. Fine. Next, moving to stock exchanges. So, we have two kinds of stock exchanges. One is the National Stock Exchange, another one is the Bombay Stock Exchange. So, under the National Stock Exchange, it was established in 1993. So, in 1993, the National Stock Exchange was established by the Perwani Committee. Recommendation of whom? Perwani Committee. And then, see, the Industrial Development Bank of India is the main promoter of this National Stock Exchange. So, who is the main promoter of National Stock Exchange? The Industrial Development Bank of India. Next, coming to the Bombay Stock Exchange, it was established in 1887, way before National Stock Exchange. Fine. So, this is Asia's oldest stock exchange. Which is Asia's oldest stock exchange? National or the Bombay Stock Exchange. So, it was known as the Native Share and Stock Brokers Association. So, earlier it was not called as Bombay Stock Exchange. The old name was the Native Share and Stock Brokers Association. It was actually owned by stockbrokers. I told no, stock brokering companies. So, it was owned by these people, which the Bombay Stock Exchange. Later, what happened? It was demutualized. What is called as demutualized? So, demutualized is nothing but it has been changed from the hands of the private to the public. Fine. See, demutualized means that the stockbrokers owned organization had been made public owned organization. The government has taken over that. So, the shares in the hands of the brokers were transferred to whom? Were transferred to the public. This process is called as what? Demutualization. Now moving to the indexes. So we have various indices in our economy, right? So under the stock exchanges, we have the Sensex, we have the Nifty, we have the Nifty Junior. Fine. So how to differentiate between these? Sensex stands for what? Sensitive index. So this is an index of the Bombay Stock Exchange. Keep it in mind, Sensex is the indicator of what? BSE and not NSE. Okay. See, the measure of the price movement of top 30 company shares is being noted. The top 30 companies are called as blue chip companies. Very important. What are blue chip companies? So, the top 30 companies which has a large amount of share that will get enlisted in the stock exchange, in the Bombay Stock Exchange. So, the price rise and the coming down of the price of all these 30 companies will be noted down. So, these 30 companies are called as blue chip companies and that is noted down in the Sensex. Now coming to the Nifty, Nifty stands for National Index for 50. So this and Nifty Junior are indices of National Stock Exchange. See, Sensex is the index for BSE, but Nifty and Nifty Junior is the index for what? National Stock Exchange. Fine. Nifty measures price movement of top 50 companies. Nifty Junior is an index of the next top 50 companies. See, I told you 30 companies is taken into account for what? Sensex. So same way, top 50 companies is taken into account for what? Nifty. But Nifty Junior is the next 50 companies. Okay. So next 50 companies is taken into account for Nifty Junior. So I hope you got the point. So the top companies are selected on the basis of total value of all shares that are traded in the stock exchange. So how are these top 100 companies? Top 30 or 50 or the next 50 is calculated. It is calculated by the value of traded shares. How much shares they are letting out and how much investment they are getting from outside. And how that is calculated? Price of one share. So take the price of one share to be 100 rupees into number of shares traded. How many people got the shares? Take it to be 100. So the total value is called as the value of the traded shares. By this the company is enlisted in the Bombay Stock Exchange or the National Stock Exchange. Fine. So that's it for the video relating to the Indian financial system on capital market in this video. Let's continue the remaining topic in our next video. Thank you for watching Get Into IAS and please subscribe to our channel and follow our Telegram link in the description box given below.